Good afternoon, everyone. Thanks for joining us for navigating the new rollover reality. I have just a few announcements for those of you who are requesting credit. Please note that to receive CE credit, you must remain logged in to the video portion of the webinar for the entire program. Logging into the audio portion is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CPE, CIMA, CPWA, CIMC, RMA, CFP, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we will answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email with a link to today's broadcast. Let's get started. We are joined today by Kate Blake, instructional designer and technology trainer at Pentegra. Kate has been with us since the beginning of her career, where she started in the retirement benefits field. And being the quick learner and talented contributor she is, Kate quickly arose into various positions with Pentegra. Kate's been able to exemplify in her deep roots of the industry experience in each position she's held, and her skills have always been the perfect complement to Pentegra's culture. Kate, I'll turn this over to you and to start talking about plan design.
Great. Thank you so much, Noelle, and thank you everybody who took the time out of your busy schedules to join us today. We have a lot of information to cover and a short amount of time to do it, so let's dive right in with a course overview and some learning objectives. We'll start out with a look at what is the new rollover reality. That includes a timeline view of some of, for lack of a better word, the chaos that has surrounded fiduciary rules and obligations over the last, at this point, decade plus, almost 15 years. We'll talk about some of the more recent notable events in the world of rollovers, including some prohibited transaction exemptions, the SEC's best interest regulation, and FINRA Notice 1345. Then we'll switch gears and we'll talk about things more from a participant perspective. So how can we aid the participants in the plans that we work with in making smart decisions with regard to their rollovers and their various options? We'll talk about key considerations of a rollover, each plan's unique options and provisions, and then we'll talk about some specific items that you may want to consider if you ever find yourself in a position of guiding participants or perhaps guiding plan sponsors relative to their plan design. And that includes in-service distributions, non-Roth after-tax sources, the NUA rules that apply to employer securities and retirement plans, DB lump sums, and then we'll summarize it all and talk about actionable things that you can do from here. Our key learning objectives today: we need to understand what's going on in the rollover landscape and how this regulation impacts us. We need to know the steps to make sure that we understand the distribution options that are available in the retirement plans that we work with, so that we can better, again, aid sponsors in terms of plan design and participants in terms of choosing the right option for them when the time comes. We'll talk about common rollover scenarios, and we'll want to make sure that we as service providers and people who have a hand in this world, that we have a process for implementing and repeating compliant rollovers. So let's dive in with a look at the new rollover reality. Rollovers are estimated to reach $760 billion annually over the next 5 years. Why? Well, it's the greatest source of dollars flowing into IRAs. I mean, this makes sense, right? With the changing demographics of our country and plus the environment that we found ourselves in during COVID and the post-COVID environment, what with the Great Resignation and things of that nature, people are changing jobs, and that is generating rollover activity. So this is an area of interest right now, given our current economic, demographic, and business climate. Speaking of the demographic climate, boomers are retiring at a significant clip now. Many are already there. Half of retirees choose an IRA rollover. The average IRA rollover of all ages is about $109,000. The average near retiree rollover is over $250,000. Here's a look at U.S. retirement assets over time, starting in the year 2000 and coming up to the present day. And what we see happening is significant growth over time in a number of different places. We see it in our DC plans. Those are our 401k, our ESOP, our profit sharing, and we see it in the IRA landscape as well. Again, demographically speaking, as more boomers continue to retire, we're going to see more of these dark blue dollars, presumably, transitioning into this light blue area. So what's driving the rollover market? We talked about this already, but just to give some percentages to it, 36%. This is as of 2021, of the rollover market is driven by retirees. So people leaving their jobs, not seeking a new job, and looking to do something with a career's worth of accumulated assets. 70% of the rollover market is represented by job changers, and that's a significant portion. Again, this is January 2021 figures, so right around the time of that, Great Resignation. And then other being 9%, and perhaps that could be something like an in-service distribution. More on that later. So what's the issue? There's a lot of activity in this market. It seems like a robust marketplace. Is there a problem? The answer is maybe not a problem per se, but I think you'll agree by the end of this hour, maybe more awareness around these topics is necessary. As you can see here, wealth management practices are really not designed for the average rollover size. Why? Because a lot of wealth management practices originated back in the day when we had the traditional three-legged stool of retirement model, Social Security, pension, 401k. That model is changing now, and we need to adapt for the changing times. Integrating a compliant, scalable rollover discipline is attractive to growth and profitability. Why? Because if you have a scalable, repeatable, compliant model in place, you're going to be in a better position to, I'm just going to, forgive me for flipping back one screen for a second, grab these dollars. Excuse me. All right, so let's talk about the landscape. Why is this an issue? What is going on? And what are we potentially looking at in the future in terms of rollover rules? Okay, so if we get in the Wayback Machine and we go back to 1974, ERISA was enacted. The holy grail of retirement plan legislation, the 4 tiers of ERISA, tells us what we need to do and creates IRAs. In 1975, ERISA regulations were created that define investment advice using a 5-part test. In 1978, an executive order was passed that further refined some of these provisions. And during this time period, 1975 through, let's say, 2010, the DOL issues some prohibited transaction exemptions and other fiduciary investment guidance. But we didn't have a big push. We didn't have anything really formalized beyond, these pieces of legislation that we've discussed here. Then we start to see what I would describe as a landslide of activity. 2005, we get DOL advisory opinions. In 2010, we get DOL proposed fiduciary regulations. And what happens from there? At this point, the DOL is kind of raising this idea of saying, hey, we haven't had any major formalized activity since 1974, 75 with ERISA. The landscape is changing. Robo-advisors are out here. There's different investment products. We got to take a look at this, you guys. So they issue these proposed regs. And then in September 2011, the DOL withdraws the proposed regs. And that kicks off further activity and discussion in this arena for years and years. In 2013, we get FINRA Notice 13-45, which we'll talk about in just a couple of minutes. In April 2015, we get DOL proposed fiduciary regulations. Then in 16, final regulations, and some prohibited transaction exemptions that replace that previous 5-part fiduciary test. In 17, President Trump issues a memorandum to review the fiduciary regulations for adverse effects. So what we're seeing happening here is a push and pull between industry and government. Isn't that always the case? What's really happening is, firms are saying, we don't have enough time, we don't have the technological ability to conform to these requirements. There were a lot of new requirements that were being put in place here. So there was a pushback to Congress to say, hey, slow down on this. We're not ready for this. We need to take another look. So we see this reflected over the course of 2017, this push and pull between business and government. In March, DOL proposes delaying the rule's applicability by 60 days in response to the pushback from industry. Then on March 10th, a couple days later, they issued a field assistance bulletin with the temporary non-enforcement policy. Later on in April, they delay applicability by 60 days to June. So we're pushing back. All this while, there's this conversation again happening between business and government. In March 18, the Court of Appeals vacates the 2016 rules. And then in 2018, the SEC proposes regulation best interest. So this is a new regulation for broker-dealers, which, as you can see, reinforces the fiduciary standard. In 2018, the DOL issues a field assistance bulletin now to delay enforcement of the 2016 rule and retroactively apply the 5-part test. So what happened there? We originally had a test, then we had something replace it in 2016, then in 18, the DOL comes back and says, oops, never mind, we're going to go back to the 5-part test. Then in 19, the SEC approves regulation best interest, which was originally set forth here in 18. That's another piece of legislation that we're going to talk about that is important today. In 2020 and over the last couple of years, we've had a continued flurry of activity around this with a fiduciary rule package in 2020, finalized prohibited transaction exemptions in 2020 as well. That's another critical piece that we're going to talk about. So there's really kind of 3 critical pieces that we've identified here. This one, the PTE 2020-02, the best interest reg, and then FINRA Notice 2013 or 13-45, which we talked about earlier. At this point in 2020, our prohibited transaction exemption rules take effect. But then in October, DOL comes in and extends non-enforcement. So again, even more push and pull. And this has been going on now, as you see, for over a decade here. In 2022, we're getting closer to the current day here. The name of the game is that we must comply with the impartial conduct standards and rollover documentation and disclosure standards, but that it won't be enforced until later on in the year. Then in 2023, the DOL again anticipates releasing a notice of proposed rulemaking of the definition of the term fiduciary. Wow. So that was a roller coaster from 1974 with the creation of ERISA, nothing happening largely until 2010, and then 13 years of push and pull between government and business about what is the definition of fiduciary and what sort of advice and education are we allowed to render around the idea of rollovers. This is really important if you are a service provider. If you come into contact with plan sponsors, if those plans allow lump sums, the idea of rollovers is a critical question that the clients or you might have to deal with, or you might get this question from employees. So, what can you do to navigate this very confusing timeline, and what are some important things that you need to know? The DOL's fiduciary rule package took effect in 2020, officially vacates the 2016 fiduciary regulations and reinstates the 5-part test. It also made a few other changes or reaffirmations. It reaffirms the interpretive bulletin regarding investment education, which is really the key cornerstone of this. What is education versus what is advice and what is allowable? And we'll talk about what is allowable in just a moment. Restores some prohibited transaction exemptions. It voided a previous DOL advisory opinion, but it also extends non-enforcement of many of these things until, a future date. So a lot happened. So where are we now? We have this old 5-part fiduciary test back. So this used to be applicable, then it got taken away and replaced with something else, but now it's back again. So the first important piece to know and understand is the 5-part fiduciary investment advice test. And it's just a yes or no test. I believe today's session is being recorded and you'll have access to this recording so you can answer these questions for yourself later on. But will an advisor render advice as to the value of securities or other property? If yes, proceed on. If no, it's not subject to the fiduciary standard. Will advice be given on a regular basis? So is this part of a retirement plan where you're giving advice to a number of participants on an ongoing basis? If yes, proceed on. Is it given pursuant to a mutual agreement, arrangement, or understanding with a plan? So are you a service provider to a qualified, say 401k plan, rendering this information? If yes, proceed on. Will the advice serve as primary, but not necessarily the only basis for investment decisions with respect to IRA assets? In many cases, the information that a plan participant receives from an advisor or, a partner on a retirement plan is a primary source of advice. And will it be individualized based on the particular needs of the plan or IRA? If so, then your recommendations are subject to the DOL's fiduciary standard. So give some thought to any recommendations that you make, around distributions, or as you can see here, the value of securities or other property, or the advisability of investing in, purchasing, or selling. So it's not just specifically rollovers, it could be purchases or really anything relating to securities or property. So this applies now. It is important to be familiar with those 5 questions. Then I want to talk about these 3 pieces of legislation that I think are important to know about. These 3 pieces of legislation kind of made it through the turmoil. They apply now, and they are something that we should all be familiar with. The first one is what we see here, the Prohibited Transaction Exemption 2020-02, the Best Interest Regs from the SEC, and the FINRA Notice 13-45. So let's go through them one by one and just talk a little bit in detail about how each one of these pieces of legislation impacts us today in practical terms. So this first one, PTE 2020-02, effective February 16th, 2021, applies to broker-dealers, RAAs, ERISA 321 investment advisors, and functional fiduciaries as determined under the 5-part test, the test we just saw on the prior slide, and financial institutions like banks and insurance companies. Doesn't apply to 338 investment managers or computer or robo-only advice arrangements. Remember, 338 investment managers, those are the discretionary, and 321 are the directed. What are the key elements of this legislation? If you're subject to it, you need to abide by impartial conduct standards. What does that mean? Uphold the best interest standards of prudence and loyalty when giving advice. Receive only reasonable compensation and make no misleading statements. I think the vast majority of people, especially people in this industry, are good people who do not intend to violate any of these tenets. However, I have seen it happen unintentionally. One of the topics that we're going to talk about today, for example, are DB lump sum distributions. Another one are the NUA rules for employer securities. A lot of people I meet simply just don't understand those rules. You could make a misleading statement by not understanding those rules. And that's why it's so important to attend webinars like this, just to make sure that you do fully understand what is available in terms of, in this case, distributions and rollovers, so that you don't inadvertently make a misleading statement, even if you don't intend to on purpose. You also need to provide disclosures, including why a rollover is potentially in an individual's best interest as opposed to a direct distribution. Mitigate conflicts of interest, and complete an annual retrospective compliance review. Were any inappropriate recommendations made? If so, why? And what action is being taken to prevent that from happening in the future? Rollovers. You must document specific reasons that recommendations to roll over workplace retirement plans to an IRA are in the best interest of the retirement investor, as opposed to, for example, taking direct distributions of installment payments and leaving the remainder in a 401k, or in the case of a pension, taking an annuity payment. We need to be able to explain why the choice of a rollover is appropriate for a specific individual. Anybody in violation of this could lose access to the class exemption for a period of 10 years for failures. What does that mean? This is a prohibited transaction exemption. That's what PTE means. Generally, we can't say this stuff because we don't know, a lot of stuff about individuals in these plans. This is an exemption to the prohibited transaction on rendering investment advice. But we have to fulfill these requirements. If we don't, lose access to this exemption for a period of 10 years. So where are we at with this? So the DOL Field Assistance Bulletin 2021-02 extends non-enforcement of some key elements of this prohibited transaction exemption. Good faith compliance, non-enforcement, was extended until 1/31/22. Documentation and disclosure standards had extended non-enforcement until June 30th, 2022. Why? Because, unsurprisingly, there still is that push and pull between industry and government. And in fact, it's not in this presentation yet because this is literally very hot off the presses, but the DOL actually sent a new version of a proposed fiduciary rule to the Office of Management and Budget late on Friday night, September 8th, so like 2 weeks ago, for their review. American Retirement Association CEO Brian Graff says that the proposed rule is expected to be publicly released in October. So a couple of weeks, we should actually have updated information on this. This is the fourth major attempt by the DOL since 2010 to revamp that 1975 set of rules, as we saw on that push and pull timeline. And interestingly to me, this actually comes despite lawmaker objections to the proposed rules. So drama in the congressional halls right now between whether or not it is appropriate to continue to refine these rules. Hence, where you see here, it ain't over till it's over. The next iteration of this presentation probably will have updates on what happened with those proposed fiduciary rules. So what does this all mean? Basically, financial professionals and their firms who provide investment recommendations, at least as of today, must meet, who meet the 5-part test are fiduciaries. A fiduciary under the 5-part test must follow a prohibited transaction exemption, such as the one we just looked at, to receive payment. So you have to make sure you follow those rules if you meet the 5-part test. Provide investment advice, of course, always under the highest standard of care, diligence, disclosure, and documentation, of course, regardless of account type. So that's one important piece of legislation that sort of made it through, so to speak. Then we have the SEC finalized regulation, best interest. So the broker-dealer compliance date you can see here is June 30th, 2020, applies to broker-dealers and associates recommending any securities transactions or investment strategies involving securities to retail customers. A retirement plan participant thinking about rolling their funds to an IRA is a retail customer. A broker-dealer must act in the retail customer's best interest and cannot place its own interests ahead of the consumer's interests. Have your disclosures, your special tax notice, all that jazz, exercise reasonable care. Make sure you explain all of the options, not just the rollover to your firm. Of course, again, most people don't intend to violate these protocols, but when I do, occasionally see areas that go into a gray area, it's maybe due to, lack of knowledge. So again, just make sure you know everything available and that you provide it clearly to participants and make sure they understand it. Address conflicts of interest. This could include things like compensation arrangements and things of that nature. And of course, any written policies and procedures set by your firm, make sure you follow them. In conjunction with this SEC regulation, there is a new Form CRS relationship summary. This is required to be completed by broker-dealers. All right, so what are our practical and tactical actions related to the best interest regs? So here, as you can see in 2023, this is one area where the SEC is stepping up examinations of best interest written policies and procedures. So does your firm have written policies and procedures? I'm going to flip back one more time that explain how you conform to these items here. That's important. The SEC is looking for that. Remember how we said earlier that if there's any violations of these rules, we have to report them? Under the best interest regs, we have to report disciplinary history on our Form CRS. And to tie this into the topic of today's webinar, which of course is the idea of rollovers, anytime we do a rollover, we already said this, but that is subject to this best interest standard. Failure to have adequate written policies and procedures, as you can see here, may indicate compliance oversight, recurring issues, and complying with the regulation best interest. So we want to make sure that we have all this stuff in place so that if the SEC comes knocking on our door, we can say that we are giving disclosures, we are exercising reasonable care, we are addressing conflicts of interest, and we have explored all of those ideas in writing. Just to explain a little bit, by the way, about what the Form CRS is, because it's new, it's a relationship summary. It tells investors about the types of services that your firm offers, fees, conflict of interest, costs, required standard of conduct, and whether the firm and its financial professionals have any reportable legal or disciplinary history, and how to get more information about your firm. In addition to other account activities, it also applies to recommendations to rollover or transfer assets in a workplace retirement plan to an IRA. We said that. Recommendations to take a plan distribution. So even if it's not a rollover, if you're recommending for some reason for somebody to take a direct distribution, you need to be able to, justify, so to speak, that as well, and ensure that you explain the alternatives, provided your disclosures. And it also applies to implicit recommendations to hold that result from agreed upon account monitoring. So, on the flip side, maybe you're saying, oh, well, your plan is great right now. You have low fees, you have good investment options, and, you're okay. And even if you don't say you're okay, that's an implicit recommendation to hold. So whether somebody takes a rollover, a direct distribution, or perhaps even no action, this reg could still apply. Here's just a quick overview of the obligations and then the detail of what you need to do to make sure that you comply with this regulation. We talked about a lot of this already: disclosure, provide your disclosures, care, the due diligence. avoid those conflicts of interest, and then the written policies and procedures. All right. The last piece, I should say, that made it through this turmoil that we're looking at right now is FINRA Notice 13-45, which talks about conducting compliant rollovers. So we need to have a balanced discussion with clients on 4 options related to their rollovers: leaving assets in the plan if it's over the cash out amount, rolling over to a future 401k or other employer plan, rolling over to an IRA, or fully cashing out. When we're comparing those 4 options, in order to be in compliance with FINRA Notice 13-45, we are recommended to look at these different items in the second bullet point with our participants: fees and expenses, services, penalty-free withdrawal options, protection from creditors and judgments, which of course applies if you leave funds in the 401k plan, RMDs, and employer stock if applicable. Alrighty, it is time for our first poll question. So which of the following statements is true? A, B, C, or D?
The polling question will be available for another few seconds for anyone who hasn't yet selected an answer. Okay, the poll is now closed. The correct answer was D. Kate, you can continue.
All right, great. Yeah, so most rollovers are subject to the best interest standard. Form CRS is not optional. The best interest standard does apply. That's one of the 3 that we talked about that made it through. And that FINRA notice is not the 5-part test, but it's talking about how to do compliant rollovers. Different options, we discuss them, we talk about fees and stuff like that. All right, so key considerations in a rollover. The taxable portion of a rollover from a qualified plan, of a withdrawal from a qualified plan or IRA is subject to ordinary income tax. So if we take a direct distribution, we're paying ordinary income tax, and we know that we have that tax schedule here in this country where our bracket gets higher the more we bring in each year. So if it's a large lump sum, it could bump us into a higher tax bracket. There's also a 10% early withdrawal penalty if the distribution is taken prior to age 59.5. But on the right-hand side, if we roll, taxes and penalties don't apply. Qualified plans generally must withhold 20% of the assets for federal withholding unless the distribution goes directly to another qualified plan or IRA. So what we're saying here is you're subject to taxation and maybe a penalty if you don't roll. If you do roll, you're not. If you don't roll, by default, we have to take 20%, but you might get, you might end up paying more or less in taxes because it goes into, ultimately your year-end tax filing. But there's a required 20% withholding on direct distributions. And investors should take into account any potential tax consequences that we're talking about here, but also expenses, sales charges, penalties for selling or buying investments before initiating a rollover. If somebody is contemplating putting funds into, another investment that has high fees associated with it, we should take that into consideration. And we should also take into consideration the fees where the funds currently are. So that's what that's trying to say in that bottom right box. Taxes, fees, and penalties should all be weighed. So who or what, I should say, plans permit rollovers? From DC plans, 401k, 403b, governmental 457, and profit-sharing plans. Traditional DB plans permit rollovers if there's a lump sum provision. Cash balance plans, in my experience, almost always permit lump sums and lump sum rollovers. IRA-based plans, simple IRAs, assets may be rolled over if the account's held for at least 2 years, and SEP IRAs. So really most, as you can see here, of our employer plans offer the option to take a lump sum and roll it. But that said, all of those different plan types have different features associated with them. So what I would like to do now with the second half of our presentation is switch gears and, as we said, talk about it from the participant perspective. So everything that we spoke about so far is what we need to do to remain in compliance when we are rendering information around distribution options to participants, specifically rollovers. But now let's talk about how we can, outside of regulation, how we can best understand the options that are available, some of the more unique options, and things like that. So each plan has a distribution trigger, depending on the type of plan and or the employer's plan design choices. For example, DB plans will generally have annuity options and or a lump sum option. The annuity, of course, is the lifetime monthly retirement income that you can never outlive, with the lump sum generally being the full and total settlement of the accrued benefit under the plan. DB plans permit annuity payments, but they're not rollover eligible, okay? So you can never put in a monthly annuity into a rollover IRA. But like we said, a lot of them do have the lump option, and that would permit a rollover to an IRA. So in a DB plan, a rollover is sometimes allowable, but not always. And once you choose your payment option in a DB plan, in my experience, that's generally it. You can't go and take a lump sum later. DC plans don't allow for distributions of deferrals prior to age 59.5, but sometimes they allow early access for non-deferral types of contributions, rollovers, or sometimes employer contributions. That can be helpful if you have people who are contemplating early retirement, maybe prior to age 59.5. So here, when we switch gears to the participant perspective, it really becomes, what are the characteristics of the participant? What are the provisions of the plan? And what works best for them? If I had a very, conservative type of investor with a DB plan, it may be in their best interest to guide them to an annuity. If I had somebody with a DC plan who was contemplating early retirement at 55, maybe I would direct them to early access of those non-deferral monies. But I have to know that those options are available. I have to understand the provisions of the plans that I work with, and I have to understand the needs of the individual that I'm working with. And then we have our IRA-based plans, which are distributable, quote unquote, on demand of the IRA owner. But as we mentioned on the previous slide, our simple IRA assets can't be rolled over within the first 2 years of plan participation. The bottom line is that you have to refer to the plan document. The plan document will tell you if and when in-service distributions are allowed, what sources and what ages, if there are NUA rules applicable to employer securities, if the DB plan has a lump sum, or if there are after-tax sources available. In addition to many other topics, these are just the ones we're focusing on today that have an impact on rollover decisions. So let's talk about those 4 items, because having a deep understanding of some of these nuances can help us better advise participants. We'll start by looking at the first of the 4, which is in-service distributions. Of course, as we all know, that's when we access plan assets while we're still working. Not all plans allow for in-service distributions. As you can see on the left, it's typically your 401ks, your profit sharing, your 403b, and your defined benefit. But it's only if the plan allows for it. Not every plan allows for it. And typically, as you can see on the right, it's going to be age-based, like age 59.5, source-based, rollovers, service-based, or reason-based. So before having any conversations with plan participants, we should, of course, always refer to the plan document. And while it is not the focus of today's webinar, there are some other webinars that we offer around plan design where we discuss having these conversations with your clients so that they can offer these types of options in a way that really meets employees' needs. But for today's purpose, we just want to make sure that we understand the document as it's written for the benefit of advising participants. So a couple stats about in-service withdrawals that I thought were interesting. Nearly 70% of profit sharing or 401k plans offer in-service distributions as of 2021. That is a lot. So that seems like a best practice in the industry. Many allow distributions of profit sharing, matching, and or rollover contributions prior to age 59 and a half, which is a pretty liberal provision regarding access to money. The average person, this is about rollover accounts, will change jobs over 12 times during a lifetime. So what do you do with that money? Who's helping you make those decisions? And are you helping others make those decisions? 12 times, 12 job changes, 12 decisions around rollovers, that's a lot to manage. There's a big opportunity here in the industry. Employees are nearing age 59 and a half who work for employers who offer defined benefit or 457 plans. In many 457 plans, a lump sum is, from what I've seen, the default payment option. And as we've said, many DB plans offer that too. So there is opportunity in the industry there as well. What is not rollover eligible? Hardship, RMDs, excess contributions, substantially equal periodic payments, including annuities, and loans, even if they are processed as distributions in default. All right, it is time for our second polling question. Which of the following distributions generally are not eligible to be rolled over?
The polling question should now appear on your screen. This poll will be available for another few seconds for anyone who has yet to select an answer. The poll is now closed. The correct answer was B. Kate, you can continue.
All right, great. Thank you so much. That's right. The RMDs are not rollover eligible, as we saw on that prior screen. So one thing that is rollover eligible, that was in the prior question we talked about, 401k after-tax accounts, not Roth, after-tax. Let's talk about what that means, who might use it, how it works, and a couple of interesting stats. So who currently has access to an after-tax source? Nearly 30% of 401k plans offer this. Many plans allow distributions of an after-tax account at any time for any reason. In fact, most plans that I've worked with offer this. Now, these accounts are separate from a designated Roth 401k. So it is not the same. They do not have the same features, and we'll talk about that in just a moment. 401k plan participants could consider making after-tax contributions if the plan allows for it, first of all. And secondly, if they would like to set aside more of their wages per year for retirement beyond the annual max. So our max this year is $22,500. If you're catch-up eligible, it's $30,000. You can actually contribute above and beyond those personal annual limits on an after-tax basis. It's also worth considering if they'd like a tax-efficient or potentially tax-free to acquire Roth IRA assets, which we'll talk about in just a minute. In short, this is for super savers or people who want to retire early, who are probably also super savers. So let's talk about how this works. Okay, so we already established that we have annual limits, right? So we have personal annual limits over here, and then we have total annual limits over here. Let's start here with the personal limits. So in 2023, we established that our personal limit is $22,500 or $30K. This is what we can put in on a pre-tax or Roth basis. You can see both of those here pointing towards the limit. On the left-hand side, this is what's called, they call it the 415 limit here. That is the proper terminology. I call it the annual additions limit. It is $66,000 or $73,500 if you are catch-up eligible. What does this mean? This means, let's just say we're not catch-up eligible, just to give an example. This means that you can contribute up to $66,000 to your account during the calendar year as the sum total of everything that comes into the plan. So what I mean is $66,000 of after-tax, employer contribution, pre-tax, and Roth. So everything can't go above that number. Way higher, though, than the $20,500 or $22,500, I guess, sorry, from this year. So what this means, let's continue with this example, is that you can contribute essentially the difference on an after-tax basis. And let me explain what I mean when I say the difference. So we have this person, Gracie, she's 52, she's catch-up eligible. Let's look down on the bottom right. Her limit is $30K. We established that because she's catch-up eligible. Let's say she does $15,000 of both pre-tax and Roth and meets her personal 402G limit of $30K this year. Top left, she then gets an employer match, dollar for dollar on 5, equal to $16,500. Her limit, her 415 limit, is $73,500. When I say the difference, what I mean is $73,500, the limit, minus this other stuff, the $16,500 and then the $30K that she put in. When you subtract those from $73,500, you get $27,000. That's why it says after tax. That means that she can contribute up to $27,000 on an after-tax amount this calendar year. Big bucks into this plan. Now, you do have to treat certain after-tax contributions separately, although with boomers entering retirement, this is becoming less prevalent. But if they're pre-1987 contributions, they do need to be segregated separately with the record keeper because it matters for purposes of the distribution. Let me show you why. Our pre-1987 contributions are distributed first, and then our post-1986 contributions and earnings are distributed second, pro rata with other balances. It was a rule change. But most people at this point are looking at post-1986 after-tax balances, which are, as you can see, distributed pro rata with other assets. So there are some neat benefits with after-tax contributions that I think you should know about. And these were codified in Notice 2014-54, which we can see here. So what this is saying is that you can split your post-1986 contributions and earnings into different accounts for a more tax-favorable distribution. But before I explain this example, let me back up just for a moment and give some context. So again, we're talking after-tax contributions here. What does that mean? It means it goes into the plan on an after-tax basis, just like Roth. But when we take the money out, our distributions of our principal, the basis, the money that we've put in, that's tax-free because we've already paid taxes on it. But our earnings are taxable upon distribution. Okay? So like if I contribute $10,000 to an after-tax account, that $10,000 is tax-free. But if it has $1,000 in earnings, that $1,000 is taxable upon distribution. So what that means is that when this person takes their distribution in retirement, they're going to have to pay taxes on a little bit of this money. Or like if they moved the entire balance to a Roth IRA, they'd have to pay taxes on the earnings at that time. This is why it matters to today's discussion, because if a plan has after-tax sources and you're advising somebody with an after-tax balance, Notice 2014-54 says that they can actually split the distribution between a Roth and a traditional IRA to pay, I shouldn't say pay no tax. It's not that they're not paying taxation, but they're deferring taxation on the earnings piece until later, right? Because if you take a direct distribution or if you put everything after tax into a Roth, you're paying tax on the earnings. But in this example, you're putting your already taxed money, the contributions, into a Roth, and you're putting the earnings that have not yet been taxed yet into a traditional IRA. I don't think this approach is right for everybody. Not everybody has after-tax balances. In fact, most people don't these days. But high earners do. A lot of the time, business owners do. High net worth people do. These are the people that are probably going to be seeking advisory services relative to their distribution options. And that's why this is so important to know about. So how do you have this conversation with people? Start by asking them the question, do you have an after-tax source? You may be able to see this in your own plan record. They'll say either, yes, I do. And if so, you'll explain it using these suggestions here, or they'll say, what's that? And then, you'll pursue different suggestions. Just remember, again, we said those after-tax amounts must be tracked separately, but most record keepers are pretty good with that these days. You can roll your after-tax account dollars to a traditional and or Roth IRA, but remember that IRS notice from 2014 gives additional guidance around that. And also, determine the in-service distribution provisions for your after-tax account. We didn't talk about this, but after-tax has so many benefits, I think. It doesn't have all the same benefits as Roth, but it has different benefits. Because as this last bullet point is alluding to, a lot of times there's no age requirements or anything to take the money out. So, again, if you're a high net worth person contemplating early retirement or advising someone who is, maybe the after-tax source can provide for that in a penalty-free and tax advantageous way that perhaps some of the other sources cannot. Okay, it's time for our third polling question. Which of the following statements is true about after-tax contributions?
The polling question should now appear on your screen. The poll will remain open for another few seconds. The poll is now closed. The correct answer was C. Kate, you may continue.
Great, thanks so much. Yeah, we saw that all plans don't allow for them. It's just if it allows. They're not the same as Roth. And pre-87 and post-86 are treated differently. Pre-87 is distributed first, and post-86 is pro rata. Okay. Special tax rules for NUA and employer securities. This is another area where I feel there is not a lot of knowledge. So this is also an area where we can help our participants find advantageous tax outcomes. So when we're talking about NUA, we're talking about net unrealized appreciation, which comes into play when you have like an ESOP or KSOP with employer securities in it, or a 401k with an employer stock available in it. If you have qualifying employer stock or securities in one of those plans, and if you or a participant you're working with is eligible to receive a lump sum that includes in-kind shares of stock. Okay, so not all of these plans allow for distribution in kind. Sometimes if it's like privately held stock or thinly traded stock, there might not be an in-kind distribution option because it can be complicated and require a market maker. But if, for example, it's publicly traded stock, and if they have an in-kind distribution option that you could roll over to, say, a brokerage, these rules could apply. If those situations apply, then, and if the payment of a participant's balance is distributed within a year due to these situations, then special rules apply. I'm going to go through this example, but I'm going to explain the bottom line first, just so you know what we're looking at. The special NUA rules say that if you take an in-kind, so in stock, lump sum distribution, okay, and put it into, like, say, again, a brokerage that accepts this in-kind distribution, you will receive favorable taxation or treatment, I should say. The way it works is the cost basis. So what it costs the employer to purchase the stock for you, or what it costs you to purchase the stock in the plan, that is taxed upon this distribution at ordinary income rates. But you're not taxed on the earnings and the growth. That taxation is delayed. Later on, when you sell the money, that growth is then taxed at the long-term capital gains rate, which is frequently more favorable than the ordinary income rate. So what's happening with favorable NUA rules, again, you have to have the availability for an in-kind distribution. You have to be able to put it somewhere that's going to accept those shares. But if they accept the shares at the time of that distribution, you're just taxed at ordinary income only on the cost basis. So it saves you on paying taxes at the time of the distribution, and then later on when you actually sell the asset, it saves you then too, because then you're taxed on the long-term capital gains rate. So this person's cost basis is $75K. That's what it costs to purchase the shares. Their growth was $275K. They're only taxed on the $75,000 when they take the money, and this is a lot. Taxation is delayed on this whole piece because of these favorable NUA rules. So it's interesting because if you take a cash distribution and you roll it to an IRA, which is typically the recommendation that we give people, if you are a high income earner with employer securities in a plan, that may not actually be the best recommendation for you. It may be better to take advantage of these NUA rules. That's going to depend, though, on somebody's, individual tax rate and other circumstances, and that's why a conversation is so important to have. But the first step is just identify if you work with any plans that offer employer securities. Then figure out whether or not they allow for in-kind distributions, because that will let you know whether or not people can utilize the NUA provisions. A caution, though, if you take a cash distribution, or if you take a distribution and roll it in cash to an IRA, you can invest it however you like. You must retain the assets in that employer's securities in order to take advantage of the NUA rules. Obviously, there is always the chance that something negative could happen to that stock, especially if it is the stock of an individual company. So, in order to remain in compliance with the SEC's best interest regs that we talked about earlier, and FINRA Notice 13-45, which talks about, suitability of different distributions, we also need to make people aware that there is risk in retaining employer stock outside of the plan. I've just got 1 minute left here, but just to wrap up, so to bring up this conversation with participants you may be working with, you can ask them, when was your last NUA analysis? If they have employer securities in their plan, they'll either say, oh, I had one yesterday, or I've never had one. And then this slide, again, you'll get this recording, gives you some tips to proceed accordingly. I think I'm out of time today, but always also if your DB plans offer lump sum payouts, keep that in mind. But this is the last topic because it's becoming less and less of a center topic these days. As you can see, only 10% of private U.S. companies offer DB plans. Only 23% of workers participate in these plans, but they are still out there. it is an option available. There are some pros and cons, of course. If you take a lump, investment risks are borne by you versus the plan or insurance carrier. So I'm out of time now, but be sure to review these pros and cons from this slide with your participants as you meet with them. With that said, Noelle, I'll turn it back to you to close us out and share any questions that may have come up in the chat box.
Thanks, Kate, and thank you everyone for attending today's webinar. Any questions we didn't get to, we'll follow up with you separately. And as a reminder, please complete the survey questions that will pop up on your screen in just a minute, and have a great rest of your day.